Let's quickly bring on board though our first guest. We have R. Subramaniakumar, who is the MD CEO at RBL Bank. Welcome on the show, sir. I want to try and first understand from you where our cost of funds headed, because there is still some bit of pressure that we're seeing with regard to cost of deposits and funds. Are we at the top now?
See, if we say that almost everything is done as far as the re-rating of the deposit is concerned, we said in the last quarter also that there will be an increase in our cost of deposit of 21 to 25 bips. That is what you would have seen it in this quarter. And more or less it is done. And there will not be any reject. But however, the new accruals, what we have will be in a rate of interest of 7.8%. So that will be adding to a few bips than what it is today. And see, one important factor how we are going to manage our margin name is that we look at the growth which we are seeing it in the asset side. There is the lot of growth you could have seen it in our retail products which we launched in the last 2 quarters, which has increased to 30%. And this is one which will be in a position to provide us enough earnings to manage our NIM.
Right, and so where should that leave your net interest margins at a steady state? Where can we see NIMs be at?
At the steady state, what we are here today, in our recall after that, it is around 5 plus, and we will continue to be in that same range. And if you see that probably 5 bips was the increase, we have seen it over the last quarter in respect of the NIMs, and we will continue to be maintaining that kind of growth in NIM.
Right, and talk to us about loan growth, right? What segments are you currently seeing traction in? What are you focusing on or choosing to focus on? And how is loan growth really playing out?
See, we maintained our guidance. We have been telling that a loan will be growing at the rate of 20 to 22%, and we have been going quarter on quarter over the last 2 to 3 quarters consistently on 20%. This time also we did an overall growth of 20%, 21%. See, the thing which has happened is that within the wholesale, the commercial loan, we guided that we will be growing at not less than 15%, which has grown at 17%. That's one big growth which has happened in the wholesale book. Second, coming to the retail book, if you look at it, all the new products which we launched, like housing loan, LAP loan, and our gold loan, 2-wheeler, 4-wheeler, business loan, everything has started improving it. And our RBF, that is a tractor loan, which we said will be, it is growing at the rate of 100% year on year. And all other products in the low base or so, our disbursement has increased. First thing to understand how this, where the growth has come is that retail disbursement X of card was around 2,000 crores in the year before. Now it is around 4,300 is what we closed this quarter. And on average, it is not less than 4,000 per quarter, which is the one which is accelerating the growth of retail credit. Of course, credit card and microfinance continue to grow the way we have been planning and projected it. Our credit card grew by 27%. And microfinance grew by 78%. Albeit it is a low base at that time, may not be growing at the same 78%, but it will never grow less than 25% when the critical threshold and mass has been achieved. So the microfinance, credit card, all other secured retail products will continue to grow, not less than 20-30%. So this is the one which is contributing, plus our commercial loan. And as we move forward, we will be in a position to catch up in respect of wholesale to some extent, wherever it makes sense for us to earn some extra margin.
Right, and if I see your Q2 numbers, I see that there's an incremental provision of around 300 odd crore which you've made this time around, some kind of additional provisioning which you've suggested. Talk to us about the rationale with regard to this incremental provisioning, as well as why the number of 300 crore.
Yeah, I just want you to take a step back and recall what we have been telling it in the beginning of the year, that we were looking at 2 different products, which is the microfinance as well as the credit card. This is a high-risk product, which we said. We also indicated that maybe by end of the year, over 1 or 2 years, we will be building up an extra contingent provisions in order to manage the down cycle if at all it happens in any time in future. So that was it is there in our thought process, and we have also articulated it. And this time there was the windfall in terms of our the return of the tax, which we got it around 298 PBT, 298 plus crores we got it. So we thought there is an option is that either you take it to the PAT, and which doesn't make sense, and it doesn't make a very business sensibility there. So we decided that the base can be created by putting that as a contingent provision. It is not an NPA provision, it's a contingent provision. So we decided that for Microsoft and microfinance as well as our credit card, we will be in a position to create at least 1% of as an additional contingent thing. This fitted into it. Since we got it, we started making additional provision. Of course, we have taken a challenge of making this 1% extra provision incrementally over the quarter on quarter, which we are confident of, because as the business is growing, our earning capacity is growing, our NII is also growing. We will be able to meet our plan of incrementally growing this 1%. And another thing what we did was that in respect of our credit card, we were providing at 90 days 70% and 180 days 100% provision was making. That we just moved that 180 to 120 days, because this is a product where it suddenly deteriorates if you are not in a position to efficiently make the corrections. So we said instead of waiting for 180 days to make that 100% provision, let us make it from 120 days itself. So going forward, these two base has been created because of that income tax return we got. And going forward, this will be definitely putting it will make our balance sheet stronger and the more predictable in future. So all the fears of having a high risk business will also move away from our mind itself.
Right. So to get this absolutely right, you're going to going forward, you're going to build on this buffer, right? Is that the correct understanding?
Yes, ongoing basis, we have also stated very clearly that we will be providing not less than 1% that is a policy, we have corrected the policy. On incremental growth of credit card and microfinance, we will be providing an 1% as a contingent provision.
Right, fully understood. Now, let me talk to you, or let me try and break down ROAs. They've been quite steady in the first half of FY24. What should one expect from the second half? Because what we are going to see probably is stability with regard to your earnings and stable asset quality as well. So can we expect ROAs to see a bit of a bump up?
Our guidance is that we will be continuing this 1% on quarter till the Q4. We will be exiting by around 20% up on that. And we are confident of continue to maintain that, achieving that guidance what we have said.
Right. We'll let you go on that note, sir. Thank you so much for giving us that context on your earnings. Let's quickly